Okie dokie. Okie dokie, everyone. Can I start off by saying either a good morning or good afternoon or even a good evening, depending on where you are around the world. And thank you and welcome to joining me tonight on tonight's latest episode of the webinar series I called How I. Now, tonight's episode is called How I Got to Understand Candlestick Patterns, Part 1. Written by yourself, of course, which is obviously James Trescothick. I'm the Chief Trading Educator here at Stratton Markets. Now, before I get on to a bit of an introduction on myself and tonight's agenda for tonight's webinar, of course, we're talking about online trading and CFD trading. Now, like with every type of investment, it does indeed carry a great deal of risk. So I do suggest you do your own due diligence and your own research and know the risks involved before entering any trade. Now, with that out the way, this hairy, wrinkly individual is myself. Like I say, my name is James Trescothick, and I am the Chief Trading Educator here at Stratton Markets. I actually started off in the financial services when I was the age of 18, so I have over 20 years experience in the financial service industry. I started off doing mortgages, specializing in commercial and buy-to-let mortgages, before moving into pensions and alternative investments. I entered the trading arena around about 13 years ago. I'm obviously a trader myself and have traded. I've also, traded gold options through the Dubai Gold and Commodity Exchange and ran several trading floors, including like the Philippine Stock Exchange. I am indeed a published writer, and I've been published in leading industry publications, including the likes of the Financial Times Advisor, The Street, Market Watch, which is obviously the Wall Street Journal, and several other leading magazines and newspapers in the industry. I'm what I would call myself is an avid market commentator. I'm incredibly passionate about the markets, very passionate, in fact. And, like many market analysts, people who analyze the market, I'm often asked for my opinions. And so, like I said, I get very passionate about it because I do enjoy it. And as well as that, I'm a well-known public speaker, and I've spoken at several public events around the world, including the likes of Singapore, Dubai, Qatar, Kuwait, Saudi, Joburg, Pretoria, Cape Town, London, Berlin, Rome, just to name a few. And some people have said that possibly I do like the sound of my own voice. Maybe it's true. Maybe it isn't. Now, tonight's episode, like I say, is called How I Got to Understand Candlestick Patterns, Part 1. Now, I will go over, first of all, different chart styles. Then I will discuss what are candlestick patterns. Then I'll do an introduction to some of the different patterns out there. Then I'll do an introduction to the head and shoulders pattern. And then we'll talk about future educational events. And of course, I'll do my usual question and answer session, which will be at the end of this webinar. So any questions, please feel free to ask me at the end. Now, before I go on, let me show you. Here I am. Hello. Hi, everybody. Good to see you. This is what I look like in the flesh, so don't be too scared. So, when you're on your trading platform, you'll notice there's several different chart types, okay? So, you've got your likes of the dots, okay? Which will show you if a asset is closed higher during the trading session or closed lower during the trading session. Okay, it gives you an indication of where it is, on that trading session or that time frame you decide to choose it on. Then you have what's known as area. Again, it will show you the high and the low, or the general movement of that asset. And it would also show you, obviously, if it's high, how much area or how much movement that particular asset is on. Is it bullish or bearish? Then you have the line, which again will show you the general direction of an asset, if people are buying it or people are selling it, if it's going up or going down. But again, it was sort of limited to the amount of information it can actually provide you. Then you have bar, which is a little bit where we're going with candlesticks. Again, it will give you if the asset during that time frame is closed higher and lower, but it also show you a little bit more information, like the potential low and the potential high and the closing, etc. But the favored choice, certainly when it comes to currencies or forex traders, is candlestick, the candlestick chart. And the reason why the candlestick chart tends to be the chart of choice, so to speak, is because it can give you an awful lot more information than either the bar, the area, the line, or the dot. And I'll tell you why that is. Now, candlesticks basically displays a movement in price of an asset in graphical form. Depending on your selected time period, each candle represents a chosen unit of time. So say, for example, on your chart, you choose 30 minutes. Then each candle represents 30 minutes. If you choose, say, for example, an hour, then each candle represents 1 hour. Daily, each candle represents a day. But as well as that, it gives you a lot more information. Now, for this illustration, and it tends to be quite a popular color choice when it comes to candlesticks, in this illustration, the green candle is showing that the asset closed higher in that unit of time. And a red candle is displaying that the asset closed lower in that unit of time. So say, for example, say each candle represents 30 minutes. Now, if we break it down, okay, this solid area here is called the body of the candle. And these little lines here is called, let me get my pen as well, make it look a bit better. The lines here are called wicks or candlestick wicks. Now, this actually shows a great deal of information. Now, if the candle is green, the bottom of the candle is where the asset opened in that unit of time. The top of the candle shows you where that asset closed in that unit of time. If it's a bearish candle, in this case of this illustration, red, then the top of the candle, or the top of the body, shall I say, shows you where the asset opened in that unit of time. And the bottom of the body shows you where that asset closed in that unit of time. How about the wicks, James? Well, the wicks shows us even more information. The top of the wick shows us the high, or where that asset went in that unit of time. Again, both on bullish and bearish candles. And the bottom of the wick shows where the asset went, or the lowest level the asset went in that unit of time, again on both candles. So straight away, candlesticks will not only show us if an asset is currently, there's more bulls buying it or more bears selling it. It shows us where the open is on a bull candle, where the open is on a bear candle, where the close is on that bull candle, or where the close is on that bear candle. But at the same time, it shows us the high and the low that asset went on both types of candles. So again, straight away, it's giving you a lot of information. Open, close, high and low, straight away in graphical form. And this is why, certainly when it comes to very liquid assets like currencies, this is really the sort of chart and, people or traders tend to favor. Because, again, they can say, where the bulls are possibly buying from, where the bears are possibly selling from, and general the overall sentiment of that marketplace at that time. This is where we come down to candlestick patterns, because there is theories and there is patterns that the way the candles are formed could possibly indicate to us where the market may go. Now, we look at the chart initially, we see a lot of, obviously, bar or candles, lots of pretty colors. It's very nice. But if we then take a closer look, we can potentially start seeing patterns. And there's those patterns we try to identify, because traders look for certain patterns to try and determine the buying and selling behavior of the market. The theory is that certain patterns can possibly indicate future movements of an asset. And let's go through some of these patterns. Like I say, this is only part one. Okay, so let's introduce and discuss some of the potential patterns you can look for and you could possibly see. Now, this particular pattern is called the hammer and inverted hammer. Like I say, a lot of these names in this, or jargon in this industry, is incredibly creative. Okay. I was just having this conversation about, obviously, Bollinger Bands, which is named after a guy called John Bollinger. And then you have Elliott Waves, which is named after some chap called Thomas Elliott. But patterns, again, they come up with really imaginative names. There's one very imaginative name, which we'll discuss at the end. But anyway, I'm digressing. But anyway, let's discuss about the hammer and inverted hammer. Now, the hammer is known as a bullish reversal pattern. Basically, traders look for it, as some believe it indicates an end of a potential downtrend. Okay, so people are looking for this pattern at an end when an asset is on a steep decline. This is how they look for this pattern, because the idea is that they can find this pattern, it potentially means the market is getting ready to change direction and start moving up again. It looks like this. A bit like a lollipop, maybe. But yeah, it looks like a hammer. So you've got the small body of the candle and a long wick below it. Okay, so basically they look for this pattern with an idea that at the end of the downtrend, if they see it at the end of the downtrend, it could potentially hint that the market is about to change and go in the opposite direction. The inverted hammer, again, they look for this to potentially see if they can identify, again, if the trend is possibly changing. And it looks like this. Again, you have the body, but this time you have a long wick above it. Again, maybe looks like a lollipop, but some people say it looks like a hammer. So let's look, for example, this is euro dollar on a 30 minutes. Remember, hammer and inverted hammer has to be formed at the end of a downtrend to hint on a potential uptrend. It can't happen in a ranging market. It has to happen at the end of a downtrend. So let's have a look. The market's on a downtrend, 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 downtrend. And what do we see here? We see a hammer forming pattern there. And guess what? The market reverses and goes on an uptrend. We see another one. Market's on downtrend, 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 downtrend. A hammer forms. And guess what? The market then reverses and goes on an uptrend. Again, downtrend, 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 being sold off. Hammer forms, and the market then reverses and goes on an uptrend. And then again, we see downtrend, downtrend, downtrend. Then we see an inverted hammer. And guess what? The market reverses and then goes on an uptrend. Here's another pattern. This one is called the bullish engulfing pattern. Now, the bullish engulfing candlestick pattern, again, potentially indicates a reversal in a downtrend. If, and this is the pattern is only works, if a bearish candle is totally engulfed by a bullish candle afterwards, at the end of a downtrend, can potentially indicate that the market direction may be changing. What I mean by engulfing, I mean the body is totally engulfed by the next bullish candle. So you have a downtrend, and then the last bearish candle is then engulfed by a bullish candle, indicates the market is changing direction. So let's have a quick look. Here's an example. Here we go. We have the British pound, US dollar on a daily. Let's face it, that pair is having a lot of fun at the moment. So we have a downtrend, and then a bearish candle gets totally engulfed by a bullish candle. And guess what? The direction does indeed change, and the market changes direction. Here's another one. This is the morning star. Now, this actually consists of three candlesticks, okay? And it consists of one bearish, one smaller bullish, and one larger bullish candle. It looks a bit like this. So you have a bearish candle, and you have a smaller bullish candle, which is then followed by an increasing bigger bullish candle. Now, clearly, this obviously looks like a little bit of a star pattern because it's a smaller body with slightly longer wicks. But the point of this pattern is it's got to be followed then by another bullish candle, which of course is then a lot larger than that candle. Now, again, traders look for this pattern to try and recognize, again, a potential bullish reversal. So again, this pattern happens at the end of a downtrend. And let's have a look here. This is again the British pound, US dollar on 30 minutes. Can you see this pattern? Straight away. Downtrend, downtrend, downtrend. Morning star followed by a bullish candle. Let's have a look. Market's on a downtrend. Pattern forms, and the market then reverses. Shooting star. Now, we've talked an awful lot about bullish or bullish reversal patterns. Let's look for potential bearish reversal patterns, which again can happen at this time on the top of an uptrend. Or again, traders look for this when the uptrend is changing. Now, this pattern looks for both hammers and, say that again. This pattern looks like both a hammer and an inverted hammer, but it forms, like I say, this time at the top of an uptrend. It looks like this. Wow, like a falling star. Again, traders look for this pattern to spot potential bearish reversals of an uptrend. So again, this is a uptrend reversal. Previous patterns we talked about are downtrend reversals. This is an uptrend reversal. Easy for me to say. And this is what it looks like. This is the euro sterling on a daily. I can spot it straight away. So uptrend, 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 falling star. There we go. And what happens after that? The market reverses on a downtrend and starts to drop. Let's do another one. This is, again, identifying a change of an uptrend to go down on a bearish reversal. This is called the engulfing bearish candle pattern. Again, it's like a bullish engulfing candlestick pattern, but it's basically the opposite. Okay, it's the opposite. And like I say, this time it occurs at an end of an uptrend. So remember the rules. The body has got to totally engulf the previous bullish candle to give us a hint and appear at the top of an uptrend, whereas the bullish engulfing candle has to appear at the end of a downtrend. This has to appear at the top of an uptrend to give us a hint of a reversal. And like I say, this is what traders try and identify for the change in direction. And let's give you an example. This is the dollar CAD 1 hour, and there's quite a few here. Uptrend, uptrend, uptrend. There we go. There's a bearish engulfing candle. Indeed, the market starts to reverse. Uptrend, uptrend, uptrend. Again, a bearish engulfing candle, and the market starts to reverse. Here we have another one. Uptrend, uptrend, uptrend. Again, a bearish engulfing candle, and the market starts to reverse, and so on. We have another one here. Uptrend here. Bearish engulfing candle, and indeed the market starts to reverse. Free white soldiers. This is another one. Again, this is more of a bullish reversal. Again, this is a bullish candlestick pattern where traders look for them to try and identify a reversal of a downtrend. Now, it looks like this. And it's basically 3 bullish candles. Each one slightly bigger than the previous one. And each one has to open at some point through the previous candle, but close above the previous candle or the previous candle's high. Okay, so let's have a look at this. I can see when again we got a downtrend here, and then we have our 3 white soldiers here, and let's have a look. The market indeed moves higher at the end of a downtrend. Let's look at another one. This is the dollar Japanese yen on a daily. Downtrend, steady downtrend. Then you get your 3 white soldiers, and the market reverses and starts to move on an uptrend. Now, I know I said about imaginative names. Okay, the 3 white soldiers, even though those green candlesticks, I guess, are quite imaginative. But a lot of them, like the hammer, falling star, aren't that really imaginative. But this one is actually quite imaginative. And in some ways, you can say maybe a little bit mean. Because this one's called the abandoned baby, and it's a very rare candlestick pattern to see. Now, again, you get the bearish and the bullish abandoned baby pattern. But like I say, the bullish abandoned baby pattern potentially indicates a bullish reversal, whereas the bearish will potentially indicate a bearish reversal. And it looks a little bit like this. So you have your bearish candle, followed by your abandoned baby candle, which is then followed by a bullish candle. But what makes the abandoned baby stand out is that the body is very close together, as in the open and close of the asset is very, very, very tight, very small. Okay, goes to showing that the market is rethinking its position and might start to move. Then obviously, if you see another candle, a bullish candle after that, indicates that the market maybe quite possibly have decided or made up his mind on where the market is going. So it looks a little bit like that. So remember, it's got to be a very, very small body. Okay. And like I say, often with the abandoned baby actual candlestick opens with a big gap from the asset. Okay, or from the previous candle, sorry. So it opens with a big gap. If it's a bearish, it opens with a big gap from the previous close. If it's bullish, it opens with a big gap from the previous candle close as well. So it's got to have a gap in it. And like I say, it's a very rare pattern to see, but it can be a very useful alert or very useful indicator to alert traders of a change in direction. And here's an example. Like I say, it's a very rare candlestick pattern. This is Amazon stock on 1 hour. Again, like I say, downward, downward, downward. Abandoned baby, again, very, very small body. That's why it stands out. Hinted with, then a bullish candle, which again possibly opens with a gap, indicating a change in direction. Now, let's have a little introduction on the head and shoulder pattern. Now, let's face it, when we're watching the charts, the market will do this. We will head up, move further, then we'll have a sell-off, then move higher, then have another sell-off, then move higher, and have another sell-off. But this is a sort of pattern we then, we look for. This is what's called the head and shoulders, because then sometimes the asset on the charts will do something like this. We'll move higher, come back down, higher, or bounce, and then lower again. And this is the sort of pattern called the head and shoulder pattern. This is what we tend to look for, because we're looking for a shoulder, we're looking for a head, and we're looking for another shoulder. Now, what's important here is that the first shoulder bounces off a certain level. The head is created, the head falls down, and bounces off the same level of the first shoulder, which then bounces back up and then comes back down again to the same level, because then that forms what we call the neckline. Because when we see the shoulder, head, and shoulder, we know next time it bounces down from the shoulder and tests the neckline, what we are then looking for is a breakout below that. Because when we can see maybe the shoulder being formed, the head, and when the head hits the shoulder line, forming another shoulder, get easy for me to say, it's my West Country accent, shoulder be formed, we know then the neckline level is a level for us to keep a key interest in, because we are then looking for a potential breakout of that neckline. So let's have a look at some examples. This is the euro dollar on a daily. Again, it's all down to interpretation. A lot of people can read these charts, but sometimes when you look a bit closely, you can actually see these patterns forming. So this is the euro dollar on a daily. So we have shoulder one. Comes down, goes up, forms a head. Head comes back down, bounces round about the previous low of the first shoulder. Then it forms the second shoulder after forming the neckline, bounces off it, and then we can see it then breaks through that neckline, doing a reversal. This is the British pound, US dollar on 1 hour. See shoulder one, which then bounces down at this level, bounces higher above the shoulder one, making a new high, so making the head. So we then know once it comes back down, it bounces off the previous neckline, shoulder, neckline, head, then here, making the second shoulder, knowing full well that when it comes back down to test the neckline again, we're then watching for it to break through and go on a downward trajectory, and it breaks their neckline, and it does indeed go on a downward trajectory. This is the USD Japanese yen on 1 hour. This time, let's just make that pattern for ourselves. So, shoulder one, bounces off it, forms a head, comes back down. Then we can see the neckline, bounces off that neckline, forms shoulder two, comes back down to the neckline, and then we see it breaks through the neckline and goes on a downward trajectory. Now, that's just a little bit of an introduction to head and shoulders. Of course, we'll do a lot more of that in part 2 and a lot more candlestick patterns. But like I say, up and coming educational events for the rest of December. We have on the 18th of December, how I came to understand the Santa Rally. So I'll be discussing the Santa Rally, or the phenomenon, or the theory of the Santa Rally, followed by a little bit on fundamental analysis in that one as well. Then, of course, I'll be releasing the January schedule at the end of that. If you wish to speak to me or have any questions, please feel free to email me at james@strattonmarkets.com, or you could direct message me or even follow me on my Twitter account, which is at jtriscothic. And like I say, you can follow me on that. I do tend to share a few bit of market oversights and things I'm seeing, but I also do it in a quite comical fashion, but like that. So if you have any questions, anything you want to reach out to me about, please feel free to email me or direct message me on my Twitter account there. Now, of course, as you know, we've been talking about online and CFD trading. And like with every type of investment, it does indeed carry a great deal of risk. I do suggest you do your own research and your own due diligence and know the risks involved before entering any trade. Like I say, if there's any questions, anything you want to contact me, please feel free to contact me on my email address or my Twitter. Or maybe even you have some suggestions or ideas about future episodes you would like me to do. Because at the end of the day, don't forget, I put this material together for your education, for your knowledge, and for your assistance. So if there's any area, any topic you'd like me to cover, please feel free to let me know. On that note, can I just say a big thank you for everybody joining me tonight. It's great to see some familiar names and faces as well. So what I will end up by saying, can I wish every single one of you either a good morning, good afternoon, or good night, depending where you are around the world. Until next time, every single one of you, trade safe.